Regulators are trying to figure out how to prevent the next financial crisis. Among the proposals under consideration is systemic risk insurance, effectively a pool of money big enough to cover the cost of winding down major financial institutions, and it would be funded by the banks themselves. It has some powerful backers, including President Obama. Here to discuss the viability of this plan is Viral Acharya, professor of finance at New York University's Stern School of Business. Viral, glad to have you back here. The big question here, everybody understands reluctantly now, of course, they've come to understand the meaning of systemic risk, but the big question is how to gauge it, effectively determine which firms are most likely to fail in the event of a crisis. You've come up with a method, effectively, based on the stock market. Explain to us how it works.
We have a simple method from our book on the crisis at NYU Stern. We have a measure called the marginal expected shortfall, or what we call as MES. The idea is rather simple. You look at the 5% worst case days of the market. How well did the stock of a particular financial firm do on those days? Stocks that do very bad are considered as more systemically risky than others.
Is it crazy to give so much power to the market in terms of interpreting the data? I mean, you're not looking at, it seems like, the balance sheet. You're just saying the market knows.
I think these stock prices contain a lot of information, and in spite of the popular rhetoric complaining that the markets didn't get things right, I think if we were looking at the right measures for systemic risk, even at the beginning of the crisis, which is as of July 2007, the market had a lot of information. So when we compute our measure for 12 months from June 2006 until June 2007, we find that 9 out of the top 20 firms that we list as being the most systemically risky as per our measure have in fact since collapsed.
Let's bring up actually some of those firms that you looked at from 2007. Again, just to emphasize, this is heading into the crisis. You went back, tested your theory to see if it could show us which firms were likeliest to fail, again, on the eve of the crisis. And here's what you've got. Some familiar names, right? Bear Stearns, Lehman Brothers, Morgan Stanley in the top 5. And then if we scroll over to the 6 through 10, you'll see some other familiar names. Goldman Sachs, Merrill Lynch, CIT Group. I mean, it's not obviously perfect, but a lot of these firms ended up being at least on the verge of failing, if not actually failing or having to be rescued, say, by the government or by Bank of America in the case of Merrill Lynch. How, though, can we be certain that this methodology is going to be useful now?
So what we've done, which gives me a little bit of reassurance, is that indeed there is some balance sheet information which is contained in these measures. So if you look at investment banks, which figured in the top 10 in our list here, we know that on their balance sheets they are 2 to 3 times, they were 2 to 3 times levered compared to, say, a typical financial firm around at that point. And interestingly, if you go back 40 years and compute these measures year by year, in each of the 40 years, investment banks had actually been more systemically risky than other financials.
But doesn't the methodology require that there be effectively no government backstopping? Because the ranking that you developed for the firms during the crisis showed some odd results. If we can bring those up, you'll see that Lincoln National, for example, ends up being number 1, and some of the firms that we might have thought as more risky, say AIG, a little further down. But again, AIG had government backing, so for the methodology to work perfectly, it would have to be in a market in which everybody can accurately assess the prospect of failure or survival without a government backstop.
Absolutely. So two things to note here. One, we recommend using stock prices rather than something like a credit default swap or an unsecured bond yield, because the latter are more likely to receive a bailout from the government than the stock prices. But we know that some equities have also received the bailout from the government, to the extent that when a bank or a financial is stabilized, the equities will surge too. So we do need government or the regulators to stay out of the equity markets.
Viral, you know the banks are going to cry foul here, saying that they've taken all kinds of measures to contain risk. They're going to point fingers at the firms perceived to be the most risky, like Goldman Sachs with $245 million of VAR in the second quarter. So how does the government sort all this out?
I think we'll have to have a fundamental shift in the way capital requirements are calculated. For example, capital requirements have focused too much on the individual risk of an institution but ignored whether this risk is systemic or not. I think we'll probably need a new legislation in place.
All right, Viral Acharya, thank you so much for joining us. Of course, the stickiest point there is going to be the fact that the banks have to pay for it themselves.
Yeah, that is going to be the sticking point.